Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kate, welcome to this episode of the Australian Finance Podcast.
It is wonderful to be back, Owen.
Yes, it is. We're recording at 5 a.m. because we have a very, very special guest with us today. Brian Feroldi, how are you going, man?
It's doing great because it's not 5 a.m. where I am. So I'm nice and chipper.
What time is it?
It's 3 o'clock in the afternoon where I am.
Oh, perfect. Perfect time to record a podcast, mate, and tell us all about your new book. To kick things off, we were thinking, how did you start learning about investing and which resources did you use when you were approaching the stock market?
Sure. So I graduated from college in 2004, and I graduated with a degree in business. Now, you might think that I was naturally taught a lot about investing in the stock market and money, given that I was a business major. Nope. I graduated from college with essentially next to zero education about money, about investing, about the stock market, about 401ks, about all the things that are incredibly important information for people to learn how to build wealth over long periods of time. But when I graduated, my dad handed me a copy of a book that was very popular at the time called Rich Dad, Poor Dad by Robert Kiyosaki. That book was like at the pinnacle of its importance in society. And I read it cover to cover in like 2 days. It was the first time that I had read a book that talked about some of the most basic concepts about wealth and wealth building and how the rich think about money differently than everybody else. And while I have gripes with that book today, and I don't necessarily agree with everything that it talks about, it was the first time that I heard things like, everybody is in business for themselves. The rich use their money to buy assets. The poor use their money to buy liabilities. Anybody can become wealthy in one generation. You can use the tax code to your advantage. And all of those concepts just completely blew my mind. Like they were the very first time that I'd heard about them before. And for whatever reason, those concepts were just extremely appealing to me, like in my personality. So I just like latched onto them immediately. And that just kicked off a never-ending binge of me really consuming financial content. So I've read tons of books. I've listened to podcasts. I've joined newsletters. I've been on forums, and like everything that's related to money, personal finance, and investing, I have just soaked up and absorbed.
Yeah, and I know that Rich Dad, Poor Dad has been that sparking point for many people in our community. We have a similar book, well, it's a bit different in Australia, called The Barefoot Investor, which millions of people have read and really changed their life based off. And it's amazing what one book can do for a large population of people. Yeah, and given how long you've been investing for, much longer than Owen and I believe, from what I've seen online, despite you don't look it, I wanted to ask you about some of those periods of investing through challenging times, such as the dot-com crash and the 2008 market crash, because a lot of us and our listeners in our community haven't actually invested through any of those times. So it's cool to learn from experiences of people like yourself who've been through it.
Yeah, so I started investing in 2004. That was when I had a job and was able to like put money in the markets. I can tell you that I remember the dot-com crash of 2000 and 2001, specifically 2001, because like everybody else in the world, I was glued to my TV on September 11th, 2001, and I saw everything that was going on with the terrorist attacks. And I vividly remember the next couple of days once the markets reopened, how everything was just straight down, like everything was just red. And I remember reading in the paper, again, I didn't pay much attention to the market, but I knew it was bad, right? I knew that it was just like horrible what was happening. And at the time, I had no clue what the Dow Jones Industrial Average was, what the New York Stock Exchange was, what the NASDAQ. I had no clue what any of those terms meant, but I did know it was bad when they were going down. And I remember thinking at the time, like, well, that's it. Like capitalism had a good run, right? This whole stock thing, I think it worked out for a while, but it's over, right? Look how bad it's doing now. And spoiler alert, it came back and it was fully recovered essentially by the time I started investing in 2004. So like I said, I was very into investing, very interested in learning. I was starting to put capital into the market and really learn about investing from 2004 until 2008. And that's when the Great Recession hit the United States. And I vividly remember numerous times putting a lot of capital into the market. At that time, my income had gone up significantly. We didn't have any kids at the time, so our savings rate was very high. And every time I put money in the market, it like immediately fell 20%, right? It was like, oh, I bought again. And it was like the next day, boy, was that a terrible decision. Like it felt so awful to be doing this and putting money in. And I'd be like, great, now I'm buying at lower prices. And then it would immediately go down. And great, I'm buying at lower prices. And immediately went down. And this happened over and over and over again for a period of months. But one thing I think I did right is that I knew that over long periods of time, the stock market went up. I don't think I fully understood why that was, but I did feel that I was buying at better and better and better prices. And I had faith that it was going to come back eventually. Although, boy, was it scary. At the time. Now, within a matter of like 3 years, I think the market had fully recovered, and it's just gone straight up ever since then. So the last 10 years have been extremely profitable period to be an investor, especially in the U.S. market. So those purchases I made that felt awful in 2008, 2009, and 2010 really have done wonders for my portfolio. And returns. Same thing. It felt the exact same way in February and March of 2020. Like the exact same way. It was like you put money in and immediately you lose, and it just goes down, like so fast. It was such a fast period to lose wealth, and it was even faster on the way up to like, nope, the market's going to go straight up from there. So dealing with volatility is never easy. However, now that I've been through numerous downturns and upturns, it makes it easier to do so, but it's still not easy.
Brian, you've published the book, Why Does the Stock Market Go Up? And I often find that it's one of those things that we take on faith rather than on science sometimes. And I'm really interested to know, like, you've written a book about this. So why does the stock market go up?
Yeah, that was one of the biggest questions that I had about investing when I first started, and even still had multiple years into studying and learning about investing. Like so many wonderful books that I read all said the same things, right? They said just continually add to the market. There's guaranteed to be periods where the market goes down, but the market will always recover magically. Like there was never any explanation. It was just the market will always recover. Just take it on faith that it'll eventually go back up. And I was like, I don't understand why that's the case, but if you look back, it's always happened, right? So I think it can continue to happen again. But slowly over time, as I learned about stocks and stock investing and markets and the fundamental drivers over a period of years, I kind of pieced together for myself the answer to the question, which was why does the stock market go back up after it falls? Understanding why it's falling isn't that hard. Right now, the markets are falling. There's war going on. There's inflation going on. There's civil unrest. Lots of like interest rates are on the rise. Bad stuff happening. It makes sense why the market goes down in those periods of times. It never made sense to me why the market would eventually go back up. But to get to the core of that question, I think you have to really, instead of focusing on the stock market, like the entire thing, it makes so much more sense to really focus on an individual company and really understand what's happening there. So let's talk about like one of the easiest businesses ever to analyze and think about, and that's just like Starbucks. Starbucks is a very simple business, right? They open up coffee shops, they sell coffee stock for a premium, and they make profit from that. Starbucks stock is up over 30,000% since it came public in 1992. 30,000%. $10,000 invested in Starbucks. You are literally a millionaire today. Why is that? Why is it that Starbucks stock is like up so much? The answer is that when Starbucks came public, there was only a few hundred of these stores like around the world, just a few hundred, primarily located in the Pacific Northwest of the United States. And Starbucks came public. It sold shares to the public because it wanted money so that it could build more stores. If you look at what's happened between then and today, Starbucks now has tens of thousands of stores all around the world, and they continue to add hundreds or maybe even thousands of stores each year to their vast empire. Every time they open up a new store, the business, Starbucks, the business, earns more revenue. And in addition to that, each Starbucks location that's existed for 10, 20, 30 years, each of those businesses tends to get more profitable each and every year as it goes by. So why is Starbucks, the business, so much bigger, so much more valuable today than it was 10 years ago, 20 years ago, 30 years ago? Answer, there's many, many more stores selling many more cups of coffee. The company has tens of billions of dollars in revenue and is producing billions of dollars in profits. That's why Starbucks used to be small and now it's big. The exact same principle applies to the stock market as a whole. It's just that it's a lot harder to understand and analyze hundreds of companies collectively than it is to analyze one business. But in the United States, the most popular common stock index that we use to measure the health of our markets is called the S&P 500, the Standard & Poor's 500. It's 500 of America's largest and most profitable businesses. And if you look over long periods of time, the S&P 500 just continually goes up. The fundamental reason for that is that the components, the 500 companies that make up the S&P 500, get more profitable each and every year. Not in a straight line, right? There's some big years it's up, some years that it's down, depending on what's going on in the economy. But if you look over the last 10 years, 20 years, 30 years, 50 years, 100 years, those businesses are far more profitable today collectively than they were 10, 20, 30 years ago. Ergo, that is why the stock market has continued to go up, because the companies that make up the stock market indices have continued to become more valuable.
That's a really interesting example. And I think sometimes people, when they're investing and in our community, can not see that, and then they get stuck with whether it's from things their family have told them about investing or they've heard from the news, and they just think, okay, well, it has gone up for a period of time, but what if it just all falls apart? How do you help people who are potentially in that doomsday mindset about investing?
Well, I think that the people that have that fear, have that worry, we're literally exactly in the same position I was 20 years ago when I didn't understand what was going on. You know, like I can tell you, I'm personally a nervous flyer. Right. When I get on a plane, it's not something that I really like to do. However, what really helped me to become less of a nervous flyer is to understand, why does a plane go up in the sky and stay up there? How does it do that? And once I understood things like gravity and Bernoulli's principles and Newton's laws of motion and the airfoil and wind resistance, it made me at least understand on a deep fundamental level, okay, there are physics at play that keep this plane in the air. It's not just like magic when you sit on. So it just made me a lot more comfortable being on a plane once I kind of understood, or at least had a basic understanding of what keeps this plane in the air. And I really focus on that tremendously when the plane is hitting an air pocket and there's like turbulence in the air. I truly think the stock market is the same way. It's like stepping onto a plane and just being like, oh, this will work. Like, it always works. Just get on. But when the plane starts shaking, if you're like me, you're like, what's going on? Somebody explain to me what is happening. That is 100% of the reason that I wrote my book. It was designed to give people the basic understanding of the factors that cause the stock market to rise over time and that cause there to be short-term volatility. And I think that once you really understand and embrace those, you can at least understand and have faith, true faith, that the stock market will eventually reach a bottom and then start to go on to new highs, because you understand the fundamental growth drivers in place.
Brian, it's interesting. Like the Starbucks example is a really good one. I think it was Tom and David Gardner from the Motley Fool that went on one of the talking shows, and they recommended Starbucks. It fell, and then they came back and they got questioned like, why did it fall? And then 5 years later, it was just streets ahead of where anyone thought it would be. So it's a lesson in patience and I guess focusing on the long term. Here in Australia, Brian, exchange traded funds or ETFs are really popular. I know amongst our community, very popular. Do you have a view on, I guess, using exchange traded funds or index funds versus individual stocks?
I think exchange traded funds are wonderful. I think index funds are wonderful. They're a true gift to investors. When people come up to me in life and they want to talk to me about investing, and they're starting from ground zero, and they say, "What stock should I buy?" I say index funds. I say, don't bother with individual stocks. Don't even try to do it. And that's not because I don't think they're smart enough to be able to understand a business and figure out a business model and figure out financial statements. Everybody is smart enough to figure out how to do it. However, there's a big learning curve when it comes to going from just buying an index fund to jumping over into an individual stock investor. And in my experience, 99% of people have no interest in going through the time and the inclination to learn how to invest in stocks simply because it doesn't interest you. And if that's you, that's perfectly fine. You don't have to know anything about analyzing an individual business to do well in the markets. You can stick with broad-based diversified index funds, and ETFs are one way that you can invest. And it really makes it super simple way to get exposure to the stock market. Now, however, if you are in that weird 1% of people, such as myself, that literally enjoys researching businesses, literally enjoys learning about studying businesses and markets, I do think that you can do well for yourself by picking individual stocks. But the huge caveat there is you have to be willing, ready, and able to do the research necessary to learn how to do it the right way.
Yeah, absolutely. And if I am interested in researching individual companies and I want to maybe better understand what a company's worth, but I'm not super familiar with fancy spreadsheets, where do I even start, and what are some of the things I should have a look at?
There's a lot that you need to learn kind of at the outset. For me, I can tell you that there are some fantastic books out there that really helped me to understand investing. There's two I will call out. These are my go-to books for a lot of people. One is called Warren Buffett and the Interpretation of Financial Statements. That's a book by Mary Buffett, who is Warren Buffett's former daughter-in-law. She used to be married to one of his sons, and she got a front-hand view about how Warren Buffett thinks about business and investing and financial statements. And in that book, they literally take the three financial statements, the income statement, the balance sheet, and the cash flow statement, and she goes line by line through them and teaches you how Warren Buffett thinks about each of those numbers. So if you want to learn how Warren thinks and how to think through business models through the eyes of financial statements, wonderful book for doing just that. Another book I'll throw out there that I really like is called The Little Book That Builds Wealth by Pat Dorsey. Pat Dorsey is the former head of research at Morningstar, and that book is all about understanding competitive advantage and how some businesses produce higher returns than others when studying their moat or their competitive advantage. And that both of those books are easy reads. They're easy to understand. So if you want to start learning how to pick individual companies, those are two great starting points.
I think that's great, Brian, because it's such the learning curve, particularly for new people, seems so steep. And it is. But once you start to piece it together, you pull threads from different authors in this case. People read your book. I think a really good answer to that last question might have been read my book, but you're very generous. And you gave us two others and one I haven't heard of there. What are some of your biggest mistakes, Brian, when it comes to investing? And I guess if you can, or if you're willing to look back on them, what are some of the takeaways that you had in making those mistakes?
I've made so many mistakes. I got plenty of lessons to teach on the mistakes that I've made. And I think that in itself is a really important point for investors. It's every investor I know, even the greatest ones, have made tons of mistakes. They've bought terrible companies, sometimes with leverage, like sometimes borrowing money to do so, and they just lost out tremendously on investments. And that's just a part of learning how to become an investor. You shouldn't set out to make mistakes. You should still have a process, but you just have to understand that you're going to make tons of mistakes going through. So let's tick through some of the ones that I've made. First mistake I made when I was brand new to the market is I got started buying penny stocks, right? I couldn't tell you anything about their financial statements, their management team, their business models, their competitive advantage, their prospects, nothing. The only thing I could tell you was their stock price was below $5. End of research, right? That was my research process was, I'll buy this dollar company because it'll go to $2. It only has to go up $1 and then I double my money, right? But Coca-Cola, that has to go up like $40 for me to double my money. Forget that. So I did terribly in the beginning because I was buying garbage and I had no idea what I was doing. That was mistake number one. Mistake number two, after that fiasco, I started focusing on dividend stocks, right? The highest yielding dividend stocks that I could find. I was like, here's a company, it's yielding dividend yields 15%. So I just got to buy this thing, not sell it, and I make 15%. This sounds great to me, right? Again, zero research, zero knowledge, zero nothing. And understandably, I lost money because once again, I was buying horrible businesses. I just didn't realize it at the time. After that, I kind of got slowly better about investing, about learning and getting my teeth kicked in a couple of times. But beyond that, the biggest mistakes that I've ever made with individual stock investing all contain one word. And boy, is this a painful word to say. That word is sell. I have owned at various times in my life a company called Dexcom, not a very well-known company. I bought Dexcom at $6 per share. Last I checked, it was over $500. I sold it at $6. I sold Microsoft at $24. Last I checked, that stock was over $300. I sold Activision Blizzard for $11. Last I checked, that stock was getting acquired at $87 per share. So I've bought plenty of businesses that have gone down, right? Plenty of them. But my biggest investing mistakes on an individual stock level were always selling future mega winners way too early. And the lost upside from selling those mega winners early, it dwarfs any potential losses that I took from holding bad companies for too long.
I think it's often missed, right? Because we often don't think more holistically about portfolios and how small positions can turn into massive positions because they keep on winning. Instead, we're very quick to sell. Kate, I don't know if you've got any more questions for Brian this morning. Otherwise, we might give you a chance, Brian, to tell people where to get the book.
Yeah, I think that's probably the most important thing. I believe it is available now in Australia.
So the book is available at all major retailers, and online is the one I know the best. Amazon, which is a mega seller of books. That's where you could pick it up. And while it is focused primarily on the United States, the principles that are in the book are by far more important than just the numbers and charts and stuff that are in there. And the principles of what a stock is, how a stock market works, why they go up and down, why they go up over the long term, are universally applicable on basically any market that you can think of. So I still think there's value to it, even though it does primarily talk about the U.S. markets.
Oh, for sure. Yeah. And a lot of our listeners are most familiar with US companies, and many of them invest internationally now. So it's a fantastic read. Brian, thank you for joining Kate and I on the show. We really appreciate it.
Oh, and Kate, thanks so much for having me.
Kate, as always, thanks for joining me on the Australian Finance Podcast.
Thanks for listening, everyone.